You've found the FarrCast, your weekly podcast with conversations from across Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us. Again this week, it is the 15th day of May, the Ides of May. Hey, doesn't seem that bad. Yeah, what didn't work out March 15th, Ides of March, not so good for Caesar. But this is okay. We've taken Caesar and ended up with Caesar salad here. We're making the best of this, folks. Yes, indeed we are. So, market's back to about even for the year. How about that? We've gone all the way down, all the way back. S&P 500 in positive territory. Nice. The draconian tariffs that were unveiled on Liberation Day have been rolled back. The data continue to suggest a disinflationary trend. I think that's a positive. Performance among the S&P 500 has broadened beyond the Magnificent Seven. The Magnificent Seven are largely back, but it's broadened, and that is a healthy sign that most every analyst has been looking for the past couple of years. And one of those classic mistakes is when you see a disparity in values where you have a Magnificent Seven or a Nifty 50, if you want to go back to the 1970s, and say all of these stocks are really expensive, and therefore all of the stuff that isn't expensive has to come up, or this expensive stuff has to come down, and we have to come to mean reversion somewhere. Actually, didn't happen the way folks thought. That Magnificent Seven, yes, there's been greater volatility. Yes, when markets really got hit, those came down a bit more. They've come right back by and large, and they've taken a lot of other stocks with them, or the other stocks are surging on their own. One way or the other, companies with strong fundamentals and good position are actually performing very well. You're in a good position, however, in one unfair way. You've got to be in a good position relative to the tariffs and the government's policy and opinions on what it is you produce and where you produce it. So that's a big deal. A lot of those consumer companies, those companies that make toilet paper and toothpaste, are having a tougher time with those tariffs. The performance has broadened out. All of these things are good. Are we through the worst of it? I don't know. I didn't know what the worst of it was going to look like a month ago. I don't know what the best of it looks like now. Are we going to stay? Can we stay at these current levels of a 30% tariff or anything like it? No, I don't think so. Not without having some real pressure on the economy. Walmart came out in their earnings this morning and said that they see higher prices on goods in Walmart stores in the near future coming because of tariffs. That's what Walmart said. We do know that we're back at 21.5 times earnings for the S&P 500, and that ain't cheap. This is not a cheap market. So if you're going to talk to folks who do what we do, they're going to tell you to follow your discipline. Number one, to stick with your long-term plan, which is the same thing they should have been telling you, and indeed we were, a month ago, 45 days ago, or 45 years ago, frankly. We always say the same thing. Stick to your discipline, your long-term plan. Don't get the emotional whoops. And always look for value, always look for opportunity, and make sure that if your positions are getting too large again, just because they're successful and feel good and are running away to the upside, doesn't mean you shouldn't sell them. It means that you should probably take a close look at all of them and consider whether that position now represents too much risk in your portfolio. What you need to do to manage your portfolio, your game plan, your strategy for you to meet your needs. If you want to meet investment needs, you need to talk to a professional. Jim Lebenthal at Cerity Partners, CNBC contributor, my great friend, and one of the smartest guys we ever get to talk to, because the guy makes sense. Lebenthal makes sense. Welcome back, Jim Lebenthal. I hope you don't disappoint and not make sense today. Don't let this be the day where you don't make sense, Jim. Good morning.
I will do my best not to disappoint. How could I ever disappoint you, Michael? You're such a good friend and a wonderful person. Thank you. Thank you for having me on.
Bless you. We're so glad you'd make the time to do this, and we know how precious your time is. You've got TV later today. You're on with our friend Jenny Harrington on CNBC at noon today, and I'll be tuned in, and I will be listening. Jim, You listened to all of my nonsense this morning. What am I missing? What would you add?
Well, far from being nonsense, you gave me many truths in there that I want to focus on. Let me start with your rhetorical question. Are we through the worst of it? The answer is we could be through the worst of it. We should be through the worst of it. We may be through the worst of it. Now, this business of predicting the future has plenty of error in it, but here's what I think. I think the markets are saying that the economy will get through this as long as we get trade deals. The UK, China moving in the right direction. We've got indications that maybe Japan, India, Korea are moving in that direction. If we can get through this tariff and trade policy uncertainty, if we can keep reducing that uncertainty, then companies are highly likely to retain workers. If they can start to see the landscape for trade rules coming into focus, then they can rotate to the balls of their feet, think about how to expand, where to expand, and most importantly, hang on to their workers, which is the means by which the economy will stay out of recession and earnings growth will stay intact. Now, what I just laid out, Michael, seems reasonable to me. I could, of course, be wrong. And this is where I want to echo something that you said as well in your intro, which is indeed, we are supposed to be long-term investors. If you and I think back to just 5 weeks ago, it felt like an apocalypse, didn't it?
Yeah, awful.
And you and I were preaching to our clients, to our friends, to our colleagues that hold on. We've been through crises before, and we will get through this. I don't know if it's a month, a year, I don't know the time frame, but we will get through it. The markets will recover. They always do. What was the feedback that I received on that is, yeah, but this time is different. This crisis is unique. Folks, every crisis is always unique. We get through them. The markets recover. The economy gets on its feet. It's just a question of how long it takes to do so. And we may well be doing so in a short time frame on the back of trade policy, uncertainty decreasing as we get through a tax bill and then get on to deregulation. Let's see what happens.
I love talking to you. You make so much sense. I met with a guy yesterday, a venture capitalist from lives here, but a European VC, if you will, private equity in Europe, got a fairly robust fund. Asking him about the future of the year, he said, I think it's a skyrocket rocket ship for the global economies from here. I said, you what? You what? He said, there is so much cash, so much liquidity, so much leverage, so much debt. Cutting of rates in the UK. He said it's going to start in the EU. It's going to start, and there's so much cash moving around the world. It's got to go up. There's so much cash on the sidelines. The world economy has to expand. You have a fundamental expansion in the world economy, and you're great. Now, I argued with him, but that's because I'm an argumentative, guy. Argued with him a little bit. He said, you sound bearish. I said, I'm never bearish. I'm always perpetually bullish for the long term, but I'm always cautious. And at 21 and a half times earnings, Jim, I'm cautious. Though I've learned, when somebody I respect, this guy went to Yale, he's a very smart fella, points out one of those old truths, and that is one of them, by the way, when there's just a huge amount of liquidity and when central banks start into easing mode, you never bet against the central bank, right? Even on the global basis. It actually gave me pause. I had to stop and say, geez, I got to think about that for a while and think about what it means. And I can get maybe too focused on the size of the debt in the U.S., which truly, ladies and gentlemen, bothers me a whole lot. And interest rates and all of these other variables that can put pressure on where we are. And I think in many ways, the debt and the increasing debt are very unsustainable long-term in the U.S. He has a point. What do you think, Jim?
Well, let me address the multiple on the market and interest rates, Michael. And then if you want to go into the debt level after that, I'll happily do so. But on the multiple, let's just consider that earnings estimates for 2026 are about $300 a share. And I submit to you that, as I said a minute ago, if we get through all of this drama and we get a good tax bill, blah, 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 maybe that's on the low side. But even if it's 300, you're trading right around 19 times next year's earnings. It's not cheap, but it's not a level of expensive that makes me concerned. But it all hinges on whether you're going to get that earnings level of $300 a share on the S&P 500. And that, again, depends on the economy getting through the trade policy uncertainty. The second thing with regards to interest rates, you really make me think, because you and I have decades of experience, many decades, sorry to date us. And if I think about the 10-year, let's call it 4.5%, and maybe the Fed cuts a few times. I agree with you, never fight the Fed. Let's say they cut a few times and the short end of the curve is 375. Maybe the 10-year is between 4.25 and 4.5. Nice steepness of the yield curve in a stable, growing economy. I would submit to you that those absolute levels, 4.5 to 3.75, are levels at which the economy can grow, your venture capitalist friend can make investments and get good returns, and importantly, savers can get a return in the bond market, which we've enjoyed for the last couple of years, but we went through 15 years before that of no return for savers in the fixed income world. So I think these numbers that we're looking at in interest rates work on both sides. They work for investors, they work for savers. There was a lot in how you just addressed me, and I don't know if you want to go into the debt level, overall right now. I'm happy to do so.
Well, it's when you are saying, I mean, if you may not agree with me that the market is fully valued at this point. Let's start there. Market fully valued. That's my sense. Yours?
Could be. Could be. You know my answer though, and it's your answer too.
There's
You gotta look at-
opportunity still out there, but would you step in and buy the S&P 500 not opportunistically if it's part of my discipline to regularly contribute to my 401k and do all of that? Yes. Is this the kind of market where you say, gee, it's just pulled back 10%, I've got extra cash, I'm going to go in heavier now? No, it's not one of those, is basically what I'm saying.
Yeah, and I think that there are sectors of the market that look more attractive than others. The financials goes right to the top of the list. If we think, and I do, that we're going to get through this trade drama and the economy is going to continue expanding, you're going to need financing, whether that's bank loans, whether that's IPOs, M&A will pick up. I mean, your venture capitalist friend sounded very much like he was ready to transact, and I like that. You're going to get good trading environment. You're going to get lower credit losses, those sorts of things. The financials are a very good place to be. And, a lot of the more economically sensitive, AKA cyclical sectors of the market are still pricing in doom and gloom. So what am I talking about? Energy markets, materials, even some industrials, although they've come back a little bit. When we look at those sectors, we don't see multiples that are anywhere near what we're seeing for the S&P 500. Now, what's propping up the S&P 500 is technology. Okay, well, the growth rates of earnings there may make those stocks not as expensive as they seem. And the point I'm really driving at here is don't look at the market overall. Sure, Michael, you said it right. If you're in your 401k and you're doing routine investments every month, go ahead. But if you're looking at the market in terms of opportunities, you do have to look at the individual sectors.
Tell me about that growth rate thing, Jim, because it's the most, I think, important thing I look at relative to the, how expensive is this thing? Where's it going is what a growth rate always implies, and how quickly is it going there? Just to make this really simple for folks, and I'm sorry, we're probably well below the sophistication of our audience, but for those out there who are newer to investing or listening to things, this earnings growth rate, earnings are the mother's milk of stock performance, the most significant indicator of stock price performance over time. Earnings growth, period. End of sentence. Not an opinion. Absolute fact. Empirical. So when he talks about an earnings growth rate on some of these big companies, this is really important to listen to and focus when he says it. Jim, tell us why.
Well, first off, let's use the numbers. 2026, that S&P 500 earnings estimate that I mentioned of 14%, of $300 a share, it equals 14% year over year growth. And if we compare that to the multiple right now, as I said, of 19 times 2026 earnings, those numbers almost correlate, right? 14% is very close to 19. That's a ratio called the PEG ratio, price to earnings to growth ratio. And I know, Michael, you wanted to keep this simple. I'm going the other direction, but I
live by PEG ratios. It's the first number I like to look at.
Right, me too, because it's the thoughtful analyst's way of saying, is the market or any stock expensive or not? If the growth rate in earnings per share approximates what the multiple is, that's not bad. That's not bad. And that's what you've got not only in the market, but you've got it in many sectors. And I mentioned technology a moment ago as a sector that is priced higher than the market overall. Well, consider what we're seeing, whether it's data centers continuing to be built out here in the US on the back of capital expenditure plans by the likes of Meta and Microsoft, which have recently been reaffirmed, or what we've heard this week about the Middle East, Saudi Arabia, and the billions of dollars that they're going to be spent, hundreds of billions of dollars that they're going to be spending on AI and data centers and the like. The growth rate in earnings in technology is likely to be higher than the market overall, and that's why its multiple is higher overall, and it makes sense, folks.
If you take a look at a company, and I'm just going to hammer this one last pound or two here with the hammer. If you look at a company, as Jim said, that is trading at 25 times earnings, but with annual earnings growth of about 10%, you might say, okay, that does kind of look expensive. That's a PEG ratio of 2.5. And if you find another company that's also selling at 25 times earnings, but growing those earnings at 30%, those two companies at 25 times earnings are very, very different, because one has some remarkable earnings growth, and at 30%, it will double its earnings in about 2.5 years. Double it, maybe triple it. I mean, maybe 3 years. 3 years, okay, 2.5, 3 years. Compounded, it's going up. So it's going to take 7 years for that 10% grower to double its earnings. So the company that can do that, and if earnings are going to drive stock price performance, that's why we prefer these stocks. I think it's a really good point to focus on our fundamentals today, Jim, as we look at individual stocks. Give us a final word for Fred and Ethel. I'm sorry we've taken so much of your time, but boy, it's been helpful. Final word for Fred and Ethel as they're going through all of this and say, okay, can I just go to the beach this summer, Jim? They say sell in May and go away. Can I just go away?
Well, you can go away and enjoy your summer, but don't sell. I don't think that's the right call at all. I mean, Michael, you know my answer, and I know you agree with me, and we do this quite often. The answer is to invest for the long term. If you're going to invest for the long term, you're going to get through the downturns like we saw in April. And we told you this at the bottom in April. We told you to stay invested and stay invested for the long term. The corollary that goes along with this, you got to be in high quality companies. You got to be in the top companies in whatever industries you're in. That's what's going to not only make it through any downturn, but thrive on the other side. Stay invested for the long term.
The new rule from Lebenthal and Farr: stay in May and go away. Enjoy your summers and trust that your portfolio will work out as the universe is unfolding as it should. Jim Lebenthal is a partner at Cerity Partners and my great friend. Have a great show today on CNBC, Jim. We'll be watching.
Michael, you're such a dear friend. Thank you.
Coming up, Lebenthal and segment 3, Jack Bouroudjian, one of our great pals who has been eerily right about a lot of things over the last few years. Please stay with us.
Michael Farr is the longest tenured CNBC contributor, and we'd like to invite you to a special behind-the-scenes look at CNBC. Coming on June 5th, Fast Money from CNBC is hosting a behind-the-scenes viewer experience of the live show at the Times Square NASDAQ market site, followed by an in-person meet and greet with the entire Fast Money team. Join fellow Fast Money fans for the ultimate exclusive in-person interactive event with Melissa Lee and the traders. Go behind the scenes and watch the up-close and rapid-paced highly charged hour with Guy Adami, Karen Finnerman, Tim Seymour, and other well-known names. Experience how the Fast Money traders debate the hot trades of the day to help you make your investing decisions. Book your exclusive ticket today to this private event and watch the live broadcast in the Fast Money VIP screening room at the NASDAQ market site in New York City, followed by an in-person Q&A, photos on the Fast Money set, and an opportunity to mingle with Melissa Lee and the traders over cocktails. For more information and tickets for the special June 5th taping, go to cnbcevents.com and select the Fast Money Live tab. And now, back to the FarrCast and your host, Michael Farr. Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back to the FarrCast. I am Michael Farr. All right, it's the 15th day of May, the Ides of May. Nobody talks about it, but maybe they should. Wait till the close of the markets today. We'll see whether we should be talking about the Ides of May et Brute. Joining us now, as he does every week, Dan Mahaffee from no longer, well, sort of the Center for the Study of the Presidency and Congress. He's a senior scholar there, but the president of the Dr. Scholl Foundation and the senior political analyst on the FarrCast. Welcome back, Dan.
Thanks. Good morning, Michael. Good to be speaking with you as always.
Always, buddy boy, always. The president is in the Middle East, and he is everywhere all at once in UAE and Qatar and moving around and offering deals. The president's offering deals. And now he's offered a deal with Iran. Haven't heard much from Iran about that. Dan, tell us what it means that the first real presidential trip, international trip, is to the Middle East. It wasn't to Europe. It wasn't to China. That in and of itself seems to make a statement. I might be wrong about that. And what's the point? What's he accomplishing? Why'd he go there? What's he doing? And what's going on with this gift of a new Air Force One? You got to be kidding me.
Yeah, well, first of all, Michael, when we get to season 9, I understand Hightower will gift me a 747 as a ninth season political analyst gift. So I am looking forward to that. And I am not bound.
I'm figuring it's the only reason you're hanging around, Dan.
Right. And I'm not bound by any constitutional prohibitions on gifts from foreign governments. So
right. Well, and it won't.
No, look, in all seriousness, though, getting back to the Middle East, one, why are they there? I think for many in the administration, and let's not go that it's so soon that the domestic agenda is on the rocks and they have to go to foreign policy. Let's not do that just yet. But for this administration wanting to turn to foreign policy, they have long felt that there is the best that happened out of the first term is what they did in the Middle East. The Abraham Accords, the deals made with the Saudis, the Gulf states, avoiding war with Iran and still applying pressure on it. They largely saw that as a success, and they want to return to that region and re-engage in ways where they feel that President Trump specifically has good working rapport with these monarchs. And certainly you could see as they rolled out the red, or in the Saudi case, lavender carpet to welcome them to Riyadh, and as we see today in Qatar and down the road in other places. So these all are ways that the administration is wanting to show that they're involved in the deal making. We have the question today of whether or not they're going to Turkey to meet with Putin. That's been up in the air. All of these things are coming in a way that suggests that this is a return to that deal making on the international stage. But we'll really see what's there. He's, the talk of bringing back that new airplane, and it's something that I at least found notable that even, usually people who are very supportive of the administration are even asking questions about whether that is the best look or entirely appropriate given the circumstances. Beyond those deals, though, what is the question? We hear things, $1 trillion in investment from some of these countries, lots of semiconductors going back the other direction. But again, other deals, I just want to wait and see when we actually see the benefits flowing versus what is written on paper.
So you're not suggesting that going to the Middle East was somehow a political statement in and of itself. You see this really as a return to successes of the past, hoping to rekindle things that worked, 5 years ago, 6 years ago. Yes?
Yeah, I see that. And if there is any political statement I would take from this, it's not a domestic one. I would note the cold shoulder that the administration has given Netanyahu throughout this.
Tell me why.
Well,
I understand that he has, but just tell me what that means in your opinion here?
In my opinion, and we're seeing this in the statements, the patience is running thin from this administration with Netanyahu. The movements on Gaza, the lack of a resolution there, the fact that Netanyahu seems to be prolonging this war, and the imagery of suffering that Trump particularly hates, that Netanyahu is prolonging this for the sake of his political future. Trump is understanding that, and I think very much tiring of that. He wants a solution. He wants a conclusion to this, and he sees Netanyahu more as an obstacle than a partner right now.
Does Netanyahu care?
That is the $4 billion a year question. Israeli politics and so much of the support for Netanyahu has long been that he could maintain these relationships with the United States and work well with U.S. presidents. But that said, it is much more now. I think he cares much more about his own domestic survival, and that requires the support of these really extreme parties that want the war in Gaza to continue.
And is there any, how does that get reconciled? Does he just leave? I mean, how does does President Trump really have significant pressure he can apply to Netanyahu? And does he have the political capital domestically to do it? There are a lot of Americans who support the state of Israel.
Yes, there are a lot of Americans who support the state of Israel, but there are also a lot of Americans who support President Trump, and both are equally on grounds of faith as well as practicality. So the
I like that, on grounds of faith as well as practicality. Those are two important qualifiers, I think, this morning, Dan. Okay, I'm sorry to interrupt, but I want to move on. Can we come back domestically? So, from all of this, Dan, is this a win for the president? I'm watching him dance to "It's Proud to Be an American" today, alone on stage. Looked kind of odd in the middle. President in the middle of the Middle East. If you haven't been to the Middle East, ladies and gentlemen, it is beautiful, and it is odd for an American. It doesn't feel like us. It feels like the Middle East trying to be America, really. That's what it feels like when you go. Is this a win for the president?
I think it's a win if we are coming back and focusing on these deals here. But as long as the headlines are about this jumbo jet, I worry it's an unforced error, actually hiding some of the successes they may be having on the ground.
Unforced error, hiding some of their successes. Yeah, well, certainly it's overshadowing. If there is a success there, this jet is overshadowing it, and unnecessarily so. All right. Moving back domestically, we still have a tax bill, and we have a Congress that looking at deficits. We have over $1 trillion deficit so far year to date. Ladies and gentlemen, it is May the 15th, and we have spent more than $1 trillion than we will take in already this year. Now, remember, the fiscal year starts October 1st. So here we are, May 1st. We're halfway through the year. But it's been, a month ago, we were over $1 trillion in the deficit. It looks like we're going to get to $2 trillion. And the administration has as its domestic agenda, main priority, this tax bill, the extension of the 20 of these tax cuts that are supposed to expire this year. And there's some other new things being thrown in, like tax on the rich so far. Some weird things for a Republican agenda. Tell us what's going on in Washington, what you're hearing, and why this particular bill and negotiation look different and don't look like they are just going to soar to success and easily slide through Congress.
No, look, yes, we see the first draft now of this tax bill, the one that they've tried to make big and beautiful out of the Ways and Means Committee, and it's moved out on a party line vote from Ways and Means Committee, but everyone thinks this is beautiful. Big sticking point, at least among Republicans, will continue to be the question about state and local tax deductions. The Republicans from the blue states really want to see that put back in. They are going to advocate for that. So where the cap is on that, is it 200,000, 400,000 in income? Is it only 30,000, 10,000 of local taxes? All these are questions that need to be resolved. As long as you also look at the other questions too. Yes, we see some of those priorities like no taxes on tips will come through. Some of the things that have been on the corporate wish list, like a return of the R&D tax deduction, that will be there for while not permanent, for 5 years. These are things that are proposed, but you also see some political elements in there. Now, as of so far, they have not looked at raising taxes on the wealthiest or the highest levels yet. They've shied away from that. But what they have looked at are very high taxes on private foundations and universities, and doing it based on endowment size, and particularly worrisome for some small universities. So there will be measures to raise revenue from them, but it will actually really harm some of the smaller entities, particularly smaller liberal arts colleges in rural areas, others like that, because so many things on the university side are calculated on a per pupil basis and not just the general size of the endowment. So these are all things that, mind you, I'm getting in the weeds here. And let's remember where we are in the process. The Senate is going to have to weigh in on this. There's going to be other elements of this that, not just the foundation and university parts that senators may have difficulties with. A lot of how this is paid for too is removing parts of the Biden IRA, Inflation Reduction Act, and some of the credits and energy infrastructure stuff that went out there. Some of those senators might defend that, even though they didn't vote for the bills during the Biden administration. They do take pride in the investments that have come into their communities now, so they probably won't want to see those gone. Ultimately, Michael, this is the tax part. We're still looking at the budget part, and we're not answering again that gap. 1 trillion so far. Is it going to be 2-3 trillion?
Dan, the president has purportedly told his economic team in Washington, I'm hearing, that he needs a win. He wants a win, an economic win from that team. Is he going to get one here? Is there going to be a bill passed? Is it going to get through? Everybody said, oh, yes, that's going to happen at the beginning of the year. Don't worry about it. That was seemed to have been a foregone conclusion. Not so much anymore. A lot of political capital has been spent, and we're arguing about $400 billion airplanes. He's got this agenda to get through. Will it happen?
For me, I think they go ahead with it. What concerns me is ultimately how do the markets respond if we're again adding more and more to the deficit, just more and more stresses to U.S. treasuries, U.S. debt. I think the question I have is, from a political standpoint, if they go ahead with this anyway, despite the absence of real clear pay-fors, and add more to the debt for the sake of getting this done, because they need the win. Deficit hawks be damned. If they do get that done, that's the question of how the markets respond to that, given all the other stresses we've seen.
So we have added well more than 10-12 trillion dollars to the U.S. debt over the last 10 years. But $10-12 trillion over the last 10 years. And we started 10 years ago at a GDP of probably 18 trillion, 19 trillion dollars, somewhere in there. And if I take that 10 trillion, $12 trillion and shove it into an $18 trillion economy, I'm going to see things expand. Things are going to go up. And one of my concerns, real concerns, has been for markets and for the growth in our economy, that it hasn't been real growth, demand pull growth. It's been driven by expanding the balance sheet with debt and actually encumbering future generations with this debt that will reach a point where there's going to be, somebody will look up and go, oh, no more debt. You can't borrow any more money. So we're inflating our balance sheet, inflating our numbers, that if you have assets, you feel good over the last 10 or 12 years. You should feel really good if you have assets. If you don't, you just saw stuff get more expensive. So I don't know how long this can last, but I certainly know that there's no real political will in Washington, because cutting programs, cutting expenses does not get you reelected. I don't know how it gets resolved, Dan, but it worries the hell out of me. I got to tell you, this worries the hell out of me.
You're getting right at it, because what you're seeing is the reluctance and outright refusal on the other side of the equation to look at some of those spending cuts. And some of these, another episode, because it's a longer debate, look at on Doge and how much savings has been released there, whether the sustainability of other cuts. But Michael, the numbers we talk about, when you get into the trillions, you're talking about shuttering not just departments, but entire swaths of the government to bridge that gap. So it becomes a question of not just how you do it, but who is willing to bear the pain. And we have never been able to answer that, as we clearly saw through all those attempts in the debt and deficit commissions during the Obama years, when we were actually trying to solve this at a time when we had people from both sides of the aisle trying earnestly to do so. I don't see that now.
All right. Well, at some point, Dan, we'd like you to, if you would, give us some insight. I know you've got a board meeting tomorrow for the Dr. Scholl Foundation. What private foundations are thinking about how they're going to operate in this new environment where endowments might come under fire? Certainly they are for major educational institutions. Give us the insights if you would. Dan Mahaffee is president of the Dr. Scholl Foundation, a senior scholar at the Center for the Study of the Presidency and Congress, a Washington, D.C. think tank, and our senior political analyst on the FarrCast. Thank you, Dan. We'll see you next week.
You're welcome, Michael. See you next week.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. May 15th, folks, middle of the second month of the second quarter. This is midway through the second quarter of 2025. We're back to even. As I said, we've had great segments with Lebenthal, interesting too, and great segment with Mahaffee. President is rounding up what is looking like a fairly successful trip in the Middle East. Now, please, no cards and letters, folks, no emails. If the president does something good, I'm going to tell you, I think he's done something good, okay? If he does something bad, I'll say that. It's not partisan. This was a successful trip for President Trump in the Middle East. I know some of you just can't stand anything he does. I know some of you love everything he does. I call him as I see him. I hope you're okay with that. Lebenthal and I started... as we're coming into my friend Jack Bouroudjian here, Lebenthal and I started with my friend who is the venture capitalist basically in Europe, in the EU. And he says that he thinks we are getting ready to skyrocket over the next year because there's so much cash and global central banks are going to begin to ease because of tariffs. Now, why they ease or that you don't like that they're having to ease, his point is when the central bank starts coming your way and it's just a matter of time, cash enters the market and share prices go up. So amidst the gloom and the doom and the fact that we are at 21 and a half times earnings, which gives me a moment of pause and caution because that isn't a cheap market by any measure, some folks are saying it's going to go up. Jack Bouroudjian has been a wise, sage voice of reason, and he's been eerily correct. Let's see what he says. Welcome back to the FarrCast, Jack.
Michael, always a pleasure. You know that.
Oh, and happy birthday a month later. I'm sorry.
Well, thanks, and happy birthday to you too, my friend.
Thank you. Jack and I are exactly the same age. By the way, Kenny Polcari, Ron and Sana, we're all a month apart. So it must have been something in the water back then, Jack, when we were all birds.
Well, you know, it's hard turning 45 again. You know what I mean? I got to tell you.
It is. You know, as I had a friend say the other day, I'm approaching 60, you know. from the wrong side.
From the
but
right, yeah.
yeah, yeah, yeah. So, Jack, you bullish, you bearish? What are you thinking about markets and prices and where we are and tariffs and the markets back into positive territory for the year?
Here, let's start it by saying this. I don't like tariffs. Tariffs are protectionism. Protectionism is a prosperity killer. It's something that I was always taught. Now,
Yes.
having said that, we are in the process right now, or at least this president and administration is, of changing the world order. And I know it sounds grand and sounds great, but this is something that's difficult. This is something that has to take a little bit of time, all right, but is absolutely necessary. And, just to go back, I mean, I was sitting at a room with the rest of the board of directors of the CME when Bill Daley, as Commerce Secretary, came in and said, we have to open up our arms to China. We have to change the way we do business and bend over backwards, all right, because we want to accept them into the new world order, because history has taught us if we don't do that, world wars begin. So we did that. We bent over backwards and we exported American freestyle capitalism to China. They embraced it, but all of a sudden the trade became unbalanced and nobody did anything about it. The time has come to balance it out, to do it right, not only with China, but with the rest of our trading partners, which we haven't done since the Marshall Plan. So let's say, for argument's sake, okay, that we get it done, that President Trump, in his infinite wisdom, all right, with the help of Besant and some of the greatest minds out there, gets this done. Well, what's it mean for the economy? All right. You couple that with the fact that you're probably going to get some real ease on the regulatory front and more than likely an extension of the tax breaks. And we're going to figure that one out. I know the Republicans are fighting amongst themselves, but they're going to figure that one out. Right. That is a combination, a formula for an explosion in the market. Now, what did we just see recently? We saw the market go down on that tariff news, but the V-shaped economy, recovery that we just saw, Michael, and this is something that you and I have seen time and time again, tells us the market was mispriced. It should never have been down there in the first place. When it V's like that, all right, it tells you something. The other part, and I just want to give all the listeners an understanding of what was happening during this whole period. Remember what was happening at night. Markets trade with liquidity when the sun is up. The markets were going through turmoil at night when you had these sovereign wealth funds, the Chinese going through their counterparties in Europe, trying to hurt the market. They were trying to make a statement, all right? And they did. They said that they were able to disprice the market, right, and create all kinds of havoc when we were not open. When we opened, we saw stability back in the marketplace. And that's something that's very important to keep in mind, because we've given these sovereign wealth funds the ability to come in and they put trillions of dollars into our markets, and they've been investing them and making a lot of money with that. All right. Now, what they're doing is they're using it as a bit of a weapon. And we saw it. It made a statement. They shot that bow, they shot across the bow. We got it. All right. But the reality is that if everything goes right, you're looking at an S&P that's going to be making anywhere from $300 to $350 a share. I mean, this is an explosion that we're talking about, a global explosion that's going to take us to 7,500 S&P in another year and a half to 2 years. It's something that you can see. It's on the horizon. It feels much like it did when Reagan took over from Carter. I remember those first couple of years were so difficult, Michael, and I was there to see it and feel it. And I was a Reagan Republican, and people were yelling at me going, look what he's doing, look what he's doing. And I was like, give it time. But he was freeing up that seed capital that ended up exploding the marketplace and making the U.S. the centerpiece for what it was.
I'm absolutely stunned, Jack, because you're not hearing anybody saying really what Jack Bouroudjian's saying, and you're not really hearing anybody saying what my friend, the venture capitalist in Europe, is saying. And folks, we may or may not prove to be correct here on the FarrCast, but you gotta admit we're giving you something new to think about, and we're not just picking things out of the clear blue sky. We're talking to people with a lot of experience who see something else. And folks of vision are the non-herd followers. These are the folks who are leaders, and they do make mistakes from time to time, and sometimes those mistakes are significant mistakes because they have a very out-of-the-box, unique perspective. But those perspectives, when born of real experience, as in the cases of both of these guys, listen. We've got to listen. You've got to stop. You've got to rethink. You've got to say, hey, maybe they're right. And if they are, do I need to change anything right now? In my opinion, good long-term investors and disciplined investors don't have to change anything right now. They're just going to sit back and go, well, I just put up with all of the crap of the last month, and that sucked. So maybe I'll just continue to sit tight, which is what good long-term investors do most of the time. And I'll sit tight, and I've got some real benefits coming. Won't that be wonderful? Wonderful. So we're not hearing a Jack Bouroudjian that's getting bogged down with $38 trillion in U.S. debt and what's happening to the cost of that and what's happening to GDP and no real balanced budget and $1 trillion in deficit spending. All of those things are still true. Jack's not getting tripped up. Jack, why aren't you getting tripped up in those things?
Because I'm seeing everything else that's happening. I'm watching these hyperscalers, and they're going to turn into $10 trillion companies, Michael. All right, you're seeing what's happening with AI. You're seeing what's happening with quantum computing down the road. There are some amazing things that are happening in the world of technology, and we are at the centerpiece of all of that innovation and that technological drive. Now, if you couple that with a new world order, which exactly is that's what this administration is trying to do. Think of it. A peace deal with Iran. Iran is now ready to talk peace. Iran is ready to give up certain weapons.
You think they really are? Iran's been an awful pain in our ass since we were kids, Jack.
Here's the secret about Iran. All right, the people are done with the administration, with the mullahs. The people are Western. There are a lot of Armenians, a lot of people in Iran. I know a lot of people from Iran. All right, and you know what? You go to their houses when you close the doors. They are as Western as it comes. Okay, they are just waiting for the time that you will see Iran be welcomed into the world order. Now, this is probably a step because remember, those in power, it's very Machiavellian. The mullahs want to stay in power. All right, so they're going to the Ayatollah wants to stay in power. He's going to do whatever is necessary to do that. So over the course of time, you're going to see this gradual change. You've already seen it. There is this détente that seems to be taking place. But more importantly, and let's go down the road with this, all right? What if crude oil, is trading at $35 to $40 a barrel consistently? What if we end up with a disinflationary pressure that's hitting the market that forces the Fed to ease, okay, and frees up even more seed capital? Again, Michael, we're creating the foundation and the recipe for something that's important. When the market broke almost 20% the other day, I got calls from my kids, all right, both of which have got investments, and they were like, Dad, I'm going to sell. I said, stop. How many times has the market gone down 20% and you buy it and you lose money? Very rarely. You have to follow the golden rules of trading. And they were like, well, what's that, Dad? I go, number one, when the market goes down 20%, you buy it. Number two, look at rule number one. Right?
Let's go to the more fundamental rule. You sell it when it's high. You buy it when it's low. And I guess to my other point is, this isn't low. So you really do have to be disciplined and careful. But long term, as I told Lebenthal, I'm always bullish. I'm always perpetually bullish on the long term. And I'm always bullish on America, Jack. Always bullish on America. So nobody's made any money betting against us through all sorts of crises in our country's history that they all were world-ending, apocalyptic, get out the book of books and read through. Oh, please. Nostradamus, great. When they start talking about Nostradamus, you should back up the truck with every nickel you have, I think. It's my Nostradamus rule, Jack. So give me this is fabulous stuff for us to think about, and I'm so grateful to you. Give us a final word for Fred and Ethel, who are saying, okay, Bouroudjian, and Farr, they're long-term guys. They keep saying the same thing over and over again, and they've got some dough now. They can afford to let this thing go up and down. I'm going to retire here in another year, and they don't have my same level of fear and my level of concerns. What do you say to Fred and Ethel, who perhaps have a valid point, Jack?
Well, no, they do have a point. And, Michael, we all know friends that are of age now that we have to be careful how we invest for them or talk to them about investing. These are people that need to get and rebalance their portfolio. Everybody should be working with a professional such as yourself, okay, that understands that can actually do that. You need to have some of it sitting in fixed income, whatever it might be. It could be private, could be public, could be whatever it is. It could be government. How safe do you want to be? It depends on how old you are and what your tolerance for risk is. But having said that, I think it's important to have a little exposure to these markets, to these equity markets. To me, there's something that's happening here. You can feel it. It's brewing. I remember saying this back, when I was a kid. I felt the same way under Reagan. I hate to say that, I use the same analogy, but it felt the same way. Market tripled in 5 years back then. All right. People didn't expect it. They sold it all the way up. They couldn't understand it. You had the Joe Granvilles of the world, if you remember that one.
Oh,
Michael.
sure.
There's a name I'm going to pull out for you. It was waiting for Black Monday. Remember, you had everybody short in the market. All right,
Yes.
market went straight up.
Straight
Okay,
up.
and you had the guy that was the Elliott wave counter. He said it was only going to go to 3,600. Dow was only going to go to 3,600. Okay,
Right.
and it was going to crash. Okay, he was wrong. I mean, again, you've got a bear out there all the time, but the reality is that you've got to have a little bit in the equity markets because the U.S. is the centerpiece of a technological revolution that, in hindsight, and I don't want to make this sound too dramatic, could make the Industrial Revolution look small.
No question about it. I'm thinking about, too, a blast name from the past, but I saw him Monday night, Jim Glassman, who was a legendary financial reporter across any syndicated Washington Post, but a whole bunch and wrote a book when the Dow was right around 9,000, 10,000, 11,000, Dow 35,000. Do you remember? He was pilloried.
I do. Yep.
Pilloried. And they had him on with me on Squawk Box, and they looked at me. Mark Haynes looked at me and said, "So, do you want to talk about this ridiculous title?" And I said, "Yeah, isn't it wonderful? Isn't it wonderful that Jim wrote this book? And isn't it wonderful that he brought this ridiculous number to the fore? Because Jim is right. Now, he will be right. If you believe in America, Jim Glassman's going to be right." And Jim was getting killed, and he called me after that almost in tears and said, "Thank you. I am getting at the end of my career," which he's not that old. He's only in his 70s, but he'd retired. Right. And he said, you saved me. And I said, "But you're right. It'll go there." and it was a big disappointment in the CNBC studio because I didn't hand Jim Glassman his rear end on air. But I mean, truly. So I'm going to tell one other reference point. There was a great lawyer in Washington, D.C., and a friend growing up whose name was Richard Nicolaides. Dick Nicolaides was a lawyer. He had 5 kids in Washington. One of the things he used to say to his kids was, "Quit looking down. Why are you looking at your feet? Is there money on the ground? If there's not money on the ground, look up and smile and make eye contact. Look at people. Quit looking down." Jack's saying a bit of the same thing. Don't get too caught up looking down, perhaps at the negatives. Get your head up and look at the big picture. I'm always cautious. And Jack Bouroudjian's got a great track record of having been pretty correct at a lot of times when he saw things that other people weren't seeing. So it's a great privilege, Jack, to have you. Thank you so much. And everybody today, whether you listen and agree with Jack or me, certainly listen to my friend, the late, sadly, Dick Nicolaides, who said, "Quit looking at the ground, look up." For everybody at Hightower, for my producer, Harry Jennings, and Farr Miller in Washington, we thank you for listening. This has been another FarrCast covering Wall Street, Washington, and the world. We'll see you next week in Washington, D.C. Grateful to each and every one of you. I'm Michael Farr.
That's a wrap on this week's episode of the FarrCast. Thanks for listening, And thanks to our guests, Jim Lebenthal, Dan Mahaffee, and special guest, Jack Bouroudjian. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcasting platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course across the changing investing environment. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep those emails and messages coming. Join us next week with our scheduled special guest, Jenny Harrington. Until then, take care, stay safe, and stay healthy. I'm producer Harry Jennings. Thank you for listening to the FarrCast, Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr Miller in Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.